edition of Overtime. I'm Scott Wapner. You just heard the bells. We're just getting started from Post 9 here at the New York Stock Exchange. In just a little bit, I'll speak to investor Kevin Simpson. We've told you how he crushed the market last year, and now he's back with some new trades this hour that he will tell you about in just a bit. We begin, though, with our talk of the tape, the massive week ahead for your money, why stocks are rallying ahead of it, and what all of it means to the market's next move. Let's ask Professor Jeremy Siegel of the Wharton School. He makes his case right here that stocks can still go up a lot more. Professor, welcome back. It is good to see you. When I last visited with you on this show on December 30th, you said the S&P could do 15% this year and that the first half of the year might be a lot better than many people thought. What did you think people were missing when you said that?
Well, I never saw so many people so bearish. And I think, as I mentioned, when everyone's on one side of the market's going to do the opposite thing. So much bearishness is built in that any crumb of good news, such as the inflation news that we've been getting, interpreted positively by the market. And of course, the hope of a pivot by the Fed next week is critically important. We have to get no more than 25 basis points. 50 would be, I think, a disaster. We need to get 25, but we also need to get the messaging that not only does the Fed see that their policy is working, but that they are very near the end of their tightening, not, oh, we have more work to do. I don't think the market will take those words very well. I think 25 basis points is all they should do. After all, by the way, we got the December money supply, Scott, which is, as you know, something that I look at closely. 2022, the lowest growth of the money supply since the Great Depression of the 1930s. Now, that's something to think about. We have the greatest inversion of the Treasury yield curve in over 40 years. The most reliable single indicator of a recession. That's something to think about. Why would the Fed want to continue and even increase the inversion of the yield curve? That's beyond me.
All right. So there's a lot there, Professor, and you used a very interesting word. You used the word hope about what the market hopes next week, about what you hope next week. And I remember the Shawshank Redemption, Professor, when they said hope's a dangerous thing. And that's what some people say now, that it's a false hope, okay? That it's a false hope because the Fed is more intent on making sure that inflation is not only down, but that it doesn't come back. And that this whole move predicated on this idea that the Fed is going to make a pivot or is near done is a false hope. How do you respond?
Well, if you shrink the money supply, inflation is not going to come back. You know, they talked about the stop and go policy of the 1970s. So really, in terms of money, they kept on pouring it on and on and on, and there was continued inflation. We have a completely different situation today. And as I pointed out, if you use current housing data, not the misleading housing data of the Bureau, which is averaged, to months and months into the past, you have negative inflation right now. So we have nothing like the 1970s. They should recognize how tight they have become so quickly that risks the economy in a recession. It's not a stop and go situation like the 1970s at all. So they don't, and they also have to recognize, and Chairman Powell says this himself, but then sometimes the way he talks, he doesn't seem like he understands it. Monetary policy works with lags. All that tightening, a lot of it is yet to be felt. You're in real negative territory for inflation. You do see a slowing of the real economy. I mean, GDP was up, but the composition was not particularly good. The only thing is the labor market that's still tight. That's the only thing. And as we pointed out, that's the worker trying to catch up to all the purchasing power that he and she lost over the last 2.5 years.
So when people say, but Professor, the economy is really strong, or it seems to be pretty strong, or at least resilient at this moment, do you think that the economy is stronger than we thought at this moment, or actually worse than it seems? How would you answer that question?
We're getting divergent. On the real indicators, it's soft. On the labor market indicators, I have to admit, I myself, looking at initial jobless claims, which I, always said is an early indicator, I am surprised on how tight that is, if that data is to be believed. But that's the last vestige of what I say is a tight market. All the other markets that you look at, we're going to get the Case-Shiller housing index next week. That's expected to be down, I think, for the 5th consecutive month. We're going to get an awful lot of data along with the Fed. It's one of the biggest weeks we had. The real data has been soft but holding up, but we have to take the warning. Monetary policy works with a lag, and I am worried that if they don't start tapering, not only tapering their increases, but stopping their increases, that we could hit a recession in the second half. That's still a live possibility, I think, if the Fed makes a mistake and tightens 3 or 4 more times.
Let me ask you your opinion on, what's been leading this rally in many respects. It's the stuff that was most shorted. It's the not profitable tech. I mean, EV stocks are up 25% or more year to date. Professor, Tesla's gone from $101 to $170. Crypto's ripping. Other unprofitable tech names are ripping as well. You really look at all of that and say that this is justified?
Don't forget, all those assets you talked about collapsed in the last 2 months of 2022. I mean, basically, what's happened is, a lot of tech selling, a lot of technical selling, and now when the new year came along, that eased up. And by the way, another very important reason why a lot of those tech names have done better has been the drop of interest rates. I mean, the Treasury rate is down. The TIPS rate is down, and that is very important for these long duration assets. So I can explain that bounce back in tech. Do I think it has legs? I don't think it's going to outperform the rest of the market from this point on for the rest of the year. I think it's a technical snapback from intense selling in November and December, aided by the drop in interest rates that we've seen.
So you would urge investors to fade it, so to speak, to fade some of those moves.
I would fade the tech rally. I would fade the tech rally if I were doing relative allocation, for instance, between value and growth. I mean, we had a big outperformance of value stocks last year. And if you do historical studies, it's not usually a one-year phenomenon. It usually goes on for 2 or 3 years. You don't usually bounce back and forth. Again, statistically, anything can happen, but that's the way I would bet my money.
Okay, I appreciate that. Let's expand the conversation, Professor. Let's bring in a couple more voices and we can debate this whole thing. Dan Greenhouse of Solus Alternative Asset Management with me here at Post 9. Marcy McGregor of Maryland Bank of America Private Bank. It's great to have everybody with us. All right, Marcy, I go to you first. I would fade the tech rally. You just heard the professor say that. He doesn't believe in that. The Tesla from 101 to 170 and some of these other highly shorted and unprofitable names. What do you make of that?
Well, I think the thing we're not talking about with tech is that, the U.S. economy is like a balloon leaking air right now. That's going to impact IT budgets for the next year or so. So I think that's going to be the next headwind for tech as a sector. The one area I'm watching, though, is semis. Semis have perked up a little bit. They're a great leading indicator. So I would watch semis right now. But I agree with Professor. I would fade the tech rally and still be a bit cautious on tech.
What's your view, Dan Greenhouse, on the market at large? Is this move something to believe and buy into, or fade. Not necessarily just talking about tech, but the whole thing, right? We're not that far away from 4,100 on the S&P 500 based on how we finished today.
Yeah, listen, the market is reflecting some of the optimistic underpinnings. I think there's a whole idea that people are getting more optimistic because the market is going up. I would actually take the other side of that and say the market is going up for reasons for which you would be optimistic, and then people are following that. But if I could just pivot back to something Professor Siegel said,
please.
That is the most optimistic take on a series of negative data points I've ever seen in my life. And I kudos to the professor for that. He talked about the yield curve, one of the most terrific leading indicators, being as deeply negative as we've seen in decades. The housing market obviously is doing quite poorly, although there are some optimistic signs right now. It's spread to the manufacturing sector. There are a whole host of reasons you would want to be pessimistic right now. And oh, by the way, the Federal Reserve is still raising rates and not likely to cut them anytime soon. And yet we put a terrifically optimistic spin on that. I find that I don't know what the right adjective would be, but so we'll go with surprising.
He really wants to say something stronger, Professor.
No.
But I will let you respond to what he said.
Yeah. Well, I guess I said 15% for the year, and what percent has been the S&P so far when we were talking at the very end of December. Listen, earnings this year are expected to come in lower than last year. It's not like we're coming out of peak earnings into a recession. If worse comes to worse and we have a recession, I'm going to tell you, yeah, there's no way that stocks are going to make headway. I mean, if they don't get the message and stop and start lowering, not just hold it for months and months on end, but lowering it, and we have a recession, I don't see we can make much progress from 4,100.
Wait. Lowering it. So you're saying that in order lower rates, like the Fed needs to cut rates to get to the target which you're suggesting?
Yeah, I think it's likely the Fed is actually going to cut rates in the second half of the year. I think they're going to see the slowdown in the economy. They're going to pronounce inflation over. Remember, they think that if inflation is over, then the rate that they should be on federal funds is 2.5. I actually think it should be a little lower, but that's by what they say it should be. As I keep on saying, don't look at the year over year that contains 11 months of old inflation. Take a look at what the new inflation is. We are very close to the target. If we use real housing data, we're below the target. So at that particular point, if the economy softens, if we see any sort of easing of that market, why wouldn't the Fed start moving back and should move back quickly to its 2.5% Fed funds goal?
Marcy, is this but a dream from the professor that the Fed's going to cut rates in the second half of the year, and that's going to spur a rally in stocks that gets you near 15% gain this year?
So I do think inflation is falling faster than many people are anticipating right now. But next week, while I think the Fed downshifts to 25 basis points, I think they're looking at the labor market. I think they want to avoid any further easing of financial conditions. So I think we're going to have a Fed that sounds really cautious next week. My base case is that the Fed may pause in the spring, but they're going to hold policy tight for the bulk of this year. I do think by the end of this year, they're at least going to sound a lot more dovish and probably be talking about lowering rates. But, I think they're going to spend a lot of this year in pause mode. And I think that's a risk. The economy is slowing. Inflation is falling quickly. But our base case is that you do get a mild recession because I think the Fed overcorrecting is a real risk right now.
See, Dan, you suggest that, you're more conflicted. That's the word that you used with our producers than you've been in years. And I feel like that goes back to the question in which I asked the professor, is the economy stronger than we thought or weaker than it seems?
I'll go with both. We talked about this last time. I think the economy is unquestionably stronger than we thought. I think Professor Siegel mentioned the strength in the labor market being surprising to him. I would agree. And everybody to whom I speak agrees the labor market is stronger than they would have thought, call it 6 or 12 months ago.
Because stronger than we thought leads you to believe that you might have a soft landing. Weaker than it seems then brings the worry of the Fed overdoing it, as we've suggested. And that puts you over a tipping point because they're impatient and they don't get it.
Yeah, well, listen, it's not not that they don't get it. I mean, the economy is unquestionably weaker than it seems. If it seems is defined by like the headline GDP number, which is call it 3% in each of the last 2 quarters, the economy was much weaker than that number would suggest. I think the problem that I have, and it sounds like I'm maybe more aligned with something that Marcy alluded to, is as you get further into the year and companies start losing the pricing power that they've had, particularly last year, and margins start to be threatened, what's the first thing these companies are going to do, presumably to hold those margins? And I assume it's going to be to at least stop hiring to the degree that we've seen, if not outright lay people off. And that is the last leg of the stool, as the professor alluded to, and we've all made the case for months. The last leg of the stool is to strengthen the labor market. And if that gives out, you're left with weakness in housing, weakness in manufacturing, and now a weakening labor market and an elevated Fed funds rate that permeates the entire economy. That is not a terrific backdrop for stocks.
Professor, what if we were to suggest that at this point, based on, as you said, what the Fed has already done, that a recession is all but a foregone conclusion at this point? It is simply a matter of whether it's a deeper recession or we just, scratch below the surface, so to speak,
right,
and it's a soft, a milder recession.
Well, yeah, there's 2 things that make stock prices. One is earnings, and the second is the interest rate. If the interest rate falls, as I expect, that can offset a softer earnings picture. But I want to comment on further on that labor market. I think a lot of firms overhired over the last year and a half. I mean, we saw what happened with tech firms. I think it permeated the economy. I mean, we saw record drop in productivity in 2022. Output per hour worked. A lot of overhiring, training, all that. As soon as we see that demand weakening and we do see layoffs, oh my God, you could say that's bad. Actually, that might improve the margins of many corporations. Getting rid of excess workers, having a labor force, we're saying, hey, I don't have to hire this person and keep them on because I, think I can't get anyone else. But there is a labor market out there that I can pick if that demand comes back, is an offset to weakness in demand that can keep margins and profits higher than many fear it might go down.
Marcy, I know we're so fixated on the Fed, and rightfully so, but next week obviously is mega cap tech, right? Take Microsoft out, they've already reported. What's hanging on that? Just given how that sector has started the year, maybe the second or third best sector year to date is technology. As we said, that the Nasdaq's up something like 11% since the start of the year. What's hanging on next week ex-Fed?
Yeah, I think a fair amount. Earnings have been pretty disappointing so far this quarter. If this trend continues, we're on track for our first negative year-over-year quarter of EPS since third quarter of 2020. Guidance has been really weak. So I do think a lot of attention will be paid to tech earnings. But I also think this is giving us this market is giving us some opportunity elsewhere. I like healthcare as my favorite sector. That's been one of the real underperformers so far in this rally and so far this year. So I would be using this market that I think is pricing in this kind of late cycle optimism right now. And I would be using it to reposition because I think while we have some volatility ahead, if I think 12 months out, I'm a lot more positive than where I am today with a market that feels like it's pricing in perfection a little bit.
Dan, you want to take that issue of what's at stake next week, right? Given what Microsoft said. Microsoft, by the way, was able to fight its way back pretty well.
Really impressive transaction.
And I'm wondering at this point, what's really going to shock us, right? We know that sort of revenue growth from the larger technology companies, the mega caps, has slowed from the growth rates of the past. At the same time when the multiples have already re-rated a lot.
Yeah, I mean, listen, we know, as you mentioned, earnings and revenue growth is going to be the slowest for many of them in many quarters, if not years. We know that they've already taken steps to lay people off and right-size the cost structure. But I just on the labor side of things, the technology sector specifically is way out front in terms of adding headcount since 2009. I'm sorry, since 2019. And so you're talking about, for the tech sector specifically, I think it's about a 20% increase in headcount for the entire space relative to just the end of 2019. What we've seen so far, while sizable and awful for everybody involved that's lost a job, is just a fraction of the headcount that's been added since. And I think if this weakness continues, you're probably going to have to see more, at least from that sector.
So, Professor, leave us with a thought here. As much as you look at the market and all parts of it, what's cheap to you? If you said you'd fade the tech rally, what is still cheap?
Well, that's for a long-term investor, valuation is everything. Short-term investor, momentum is almost everything. Long-term valuation, I just looked at the value. I think NASDAQ, now I know that's not just tech, selling for 25 times earnings projected. S&P is 17. The value part of S&P is 13 or 14. Europe, which was 10 last year, has rallied 10%, so it's now 11, 11 and a half. Asia is 12, 13. I mean, around the world, cheaper than the United States. Has the worm turned so that finally we might have outperformance of global stocks relative to the U.S.? That very well could be in the cards for 2023.
You guys all have a great weekend. I really enjoyed this conversation. Professor, thank you as always.
Thank you.
You always bring it, and we appreciate that. Marcy, we'll see you soon. Dan Greenhouse right here at Post 9. We'll catch you soon as well. Let's get to our Twitter question of the day. We want to know, which big tech earnings are you most focused on next week? Is it Meta or Alphabet or Amazon or Apple? Head to @CNBC Overtime on Twitter. Cast your vote. We will share the results a little later on in the hour. We're just getting started, though, here in Overtime. Up next, forget big tech. That is the message from Payne Capital's Courtney Garcia as we head into a huge week for tech earnings. She also, by the way, agrees with the professor on something he said, and I know what that is. And you will, too, when she joins me here at Post 9 right after this.